Thanks for tuning into Talking Point. I'm your host, Niraj Shah. The case for a chat today, you can't take your eyes away from what the Fed has done, but you obviously can't take your eyes away from what Accenture has guided to. So in some sense, there's this push of policy action versus demand. So the case for a chat will come up on your screen next, and we are going to be talking about whether 2024, India remains in the global spotlight, whether outlook for IT remains subdued, whether the Fed action prompts risk asset managers to up their bets on risk assets / equities per se, and whether fixed income and precious metals become a space to bet on. The gentleman who is our guest today, back in Jan 2023, had said that there are options beyond equities, and he's self-confessed in a previous interview that in some sense equities still did well. So he said he doesn't want to make any forecast, but we've gotten him to do precisely that. Vetri Subramaniam, Chief Investment Officer at UTI Asset Management Company, joins us. Vetri, so good having you. Thanks for taking the time out.
Thank you. Thanks for having me in this lovely studio.
The pleasure is entirely ours. So how do you feel, Vetri, about the whole process of investing? Because just the volatility in news flow always is high, but it's certainly not low this time.
Sure. Again, you know, the way I look at this, Niraj, actually I don't see volatility as being high, because if you look at volatility either in terms of historical volatility or in terms of the volatility that we can look at in the options market, both are actually very muted.
Sure.
I think the definition of volatility sometimes hides the language that we should be using, which is the market's not going up every day. But the market is not supposed to go up every day, right? So I think that's the wrong definition of volatility. The market actually remains very, very low in terms of volatility. And you know, the bigger point that I would make, and I always tell investors this, if you're going to invest in equities, expect that the market will drop at least 10% once every year, expect that the market will drop 20 to 25% every 2 to 3 years, and once every 10 years it might even drop 30, 40, 50%. That's going to be part and parcel of your journey. When you look at it in that context, I don't think anything we've experienced in the last few months amounts to volatility.
Yeah, no, but just the volatility in news flow is what I meant, because there it's very chop and change for all the hawks around Fed and what the Fed delivered yesterday or day before last night, I mean, was pretty different from what anybody could have anticipated. So in some sense, there is a bit of a chalk and cheese effect.
Partly true, but again, I would say, look, you know, in the markets, there's always something going on, right? If you were to tell me that there's more news flow today as compared to 2020, when at this point of time, we were all getting locked up at home and we didn't know where, you know, the future looked like, I would say that was a lot more uncertain than it is today. So yeah, I mean, these are all small things. Look, the Fed policy, MPC policy, these are all part and parcel of the discussion about markets, but these can't be the sole determinant of what investors choose to do.
True.
So, you know, I treat this as part of the weather. You know, should you dress appropriately for the weather? Yes, answer is yes, but you don't change your, you know, strategic objective because of what the short-term weather forecast is. So that's the way I look at it.
Okay, and I'll come to the strategic objective as well, and earnings growth and other factors.
Sure.
But just a word about the weather too. I mean, does it look like the mood might have changed at the margin because of what the Fed reiterated? Nothing different, but reiterated.
Sure. I think that's a good question, Niraj. And you know, you go back to January, and I remember looking at the data, people were expecting as many as almost, you know, 5 to 6 rate cuts during this year. 140 basis points was what the Fed implied was showing. That's now obviously down to about 75. And you know, to that extent, I would say the market's already sort of shifted in its expectation that growth is going to be much better than anticipated. Inflation seems to coming down, not net near target, but coming down. But to my mind, you know, the more interesting thing which actually emerged from the Fed messaging day before yesterday was the fact that they have actually indicated a willingness to walk back on quantitative tightening. To my mind, that was actually the most critical part of the messaging as opposed to anything else. Because I think one of the challenges that the US Fed in particular and the US Treasury in particular faces is that unlike central banks all over the world or governments all over the world who increased their average tenure of borrowings in the post-pandemic periods when rates were close to zero, the US Treasury never did that. And they actually continued to borrow very, very short term. In fact, in the last 1 year, they have predominantly borrowed treasury bills, which I would actually submit is a very dangerous strategy to follow. But therefore, they will sooner or later have to replace that treasury bill borrowing with dated security borrowing. Now, imagine a scenario in which the US government is continuing to happily run deficits of $6 to $7 trillion a year. They're going to have to issue long-dated bonds, and now the biggest holder of bonds, which is the US Fed, is also saying, I need to sell bonds into the market. So if there was a reason to breathe a sigh of relief, it's simply that the Fed for the first time in a way sort of blinked and said, okay, you know, we might have to rethink how much and how aggressively we sell bonds. So that messaging on QT was, to my mind, the most significant part of what came out. And maybe there is nervousness, and rightly so, there should be nervousness, because I think the US Treasury has played what I would say is a fairly risky game of borrowing so much in T-bills and not in dated securities.
So considering this aspect that's happening in the US, considering that BOJ, albeit in a gradual fashion, but there is a bit of a quote-unquote policy normalization as well that has happened.
Correct.
So central banks are talking a very different tune than what they have in the last 3 years. What's the impact to your mind on risk assets per se over the next 9 months, probable impact?
So, you know, we talked about Tina versus Tara, and I think in the Indian context, it certainly didn't work. Global equities worked very well. But I think the fact of the matter remains that what we discussed last time in terms of the underlying change in not just weather, but in terms of climate is very, very pronounced. It is pronounced because it's very clear we've moved away from zero interest rates, right? Japan is the last one to sort of exit that territory. And therefore, as a result, bonds have become a valid asset class in any global investor's portfolio. And this is already visible in what's happened in the US. So which asset class in the US pulled in the largest amount of money last year? It was US money market funds. They pulled in almost $6 trillion of money simply because people are saying, hey, I can actually get, 4.5%, 5% over there. I'm happy to take that because I haven't seen this kind of, reasonably safe return on a safe liquid asset for a long period of time. So I think that will continue to remain a challenge, that bonds have once again become a valid asset class in the pools of money, which are the largest pools of money, which are trying to meet retirement obligations, and you want to use a balanced portfolio of bonds, equities, so on and so forth. The mad rush to go down the risk curve to get better returns, that period is now behind us. So I think this is a change in temperature that we will have to continue to deal with, that bonds are once again a valid investment instrument in global investor portfolios. And I think that will continue to pose challenges to equities. And from that point of view, therefore, high equity valuations, I would be a little bit worried and circumspect, because incrementally, rather than people hunting for yield by going down the risk curve, they are going to go back to the stability of what bonds are willing to offer them.
So actually, I would love to understand this from you, because it's a tricky thing. Higher for longer rates, even if rates were to come down, therefore bonds and valuation multiples both get impacted. But if there is a series of rate cuts, it may not be 7, it may not be 6, it may be 3. In some sense, if it enhances the appeal of emerging markets by and large, what is that next 9 to 12 months of presumably 3 rate cuts have in store, therefore, for equities and EM equities in particular, considering the point that you just made in the previous answer versus the appeal of EMs in a rate downward trajectory?
Sure. So I think the critical difference here, I would submit, is that we don't see the long bond yield coming down dramatically. And equities are eventually priced relative to the long bond yield rather than to the short-term money market rate, right? So will the Fed cut? Sure, they most probably will cut. It should get cut at some point of time. Likely in India as well, at some point towards the end of the year, we will cut. But that's not the important number on which people price equities. What they price it on is where is the 10-year bond yield. And the key, I think, is that that is not going to come down, for the simple reason that inflation looks like it is higher for longer. The West, and particularly US, has suddenly discovered this new toy called fiscal deficit. No signs of bringing it down, unlike India, where we're actually continuously looking to tighten fiscal deficit, going into 26. And if you look at what the finance minister, of course, new parliament, etc. But the finance ministers actually now even talked, and if you see recent commentary, not just the fact that we need to bring down the fiscal deficit and be disciplined, but also talking debt to GDP. And this is happening in an environment where the US is not even talking about these things. The CBLO is, but otherwise they're not, CBO is, but the government is pretty happy to run fiscal deficit. So I think equities will get priced off the long end, and that is where we need to be cautious. I don't see the long end coming down.
Okay, so before we take that break, one more macro question with regards to India, therefore. Yesterday, Morgan Stanley reiterated their call that it is India's decade. In some sense, we're talking about a very fiscally responsible finance ministry at the helm of affairs currently. And growth numbers, not anemic certainly, even if not as strong as the last 3 years, if you will. How favorably does that place Indian equities in light of the fact that the valuations are still high for them?
I think you're absolutely right. In all our conversations, and we raise money from a lot of global investors, which we manage almost $3 billion of global money.
Wow.
I think there's no doubt about the fact that most people say, look, India is a very structural component of our portfolio, and we want to continue raising our exposure to equity in India simply because we can see the long-term structural opportunity. But that's one part of the story. The other part is, what am I paying for it? Right? And I think that's where it starts to get slightly more tricky, because valuations in India are expensive. Equities in general across the world are expensive at this point of time, particularly the US. And in India as well, you are having to pay a significant premium to that. So I think to that extent, the sort of appetite has been a little bit more muted. I would submit more muted than what perhaps people have hoped for. That's been offset by the fact that domestic demand has been very strong. But I would really interpret the setup to say that if for whatever reason Indian equities were to correct or come down, you will start to see a lot more stronger foreign bid. And just 2 points I want to make here. Indian equities have reached a premium where it's interesting to just think through the mindset of global companies. We've had 2 or 3 global companies in recent time come and say, you know what, we are happy to sell down some of our stake in India, right? So when you have these high valuations, it's not surprising that rather than seeing a rush of global M&A inbound into India, you're actually seeing some of these MNCs saying, hey, we can actually sell some of these rich assets in India. The other interesting that I want to point out is that everybody only talks about how much money is coming into the market, particularly the local money is coming into the market. Look at the amount of stock sales which are being made by PE funds, VC funds, promoters, QIPs, OFS, IPO. If you look at that number for 2023, actually there was $45 billion of buying by FPIs and domestic institutional investors. There was close to $38 billion of what I can count of sales of primary fundraising or secondary sell downs by these investors. So, at these valuations, you're also attracting a lot of supply. I think it's a great decade for India as a country. Capital availability, economy grows, all of that. Equities, I'd argue that I want, valuations which offer more margin for comfort.
Vetri, we spoke about the macro by and large. We could go on with that, but have to bring in a little bit of the micro element as well. Do you foresee earnings growth to be a challenge in FY 25-26, or maybe FY 25-26 is too far to put out? And what are the pockets of challenge? Could it be BFSI, which hasn't quite delivered on stock price returns, even if the performance has been okay? Could it be technology on the back of even Accenture saying that they don't see a demand, this thing? Those are 2 large ones, or some others?
Sure. So if you look at the Bloomberg consensus, it's now penciling in about 14% growth in earnings for the Nifty 50. That's the consensus number for 25. Not too different from what actually happened in 2024. Will happen because we're still at the final quarter numbers are to come in. But I think that's pretty much in the bag. I think the big difference is, if you look at the 24 number, Niraj, the challenge is that top line growth was actually very weak, and the entire growth in earnings was actually driven more by EBITDA expansion, because the base year actually had a lot of the impact of the post-Russia-Ukraine sort of disruption in supply chain and prices. I think the key for 2025 is that it will have to be more revenue led. I don't think there is scope now for EBITDA margins to expand anymore. In fact, given, as you rightly said, there are some pockets within the economy where for a variety of reasons things are a little bit tighter, there is very limited scope for margin expansion. So I think it will have to be now led more by revenue growth rather than by margins. That's point number one. The outlook, I think, for revenue growth reasonably good, though the consumption side of the economy, as we can see most high frequency numbers, is challenged. Investment side doing better, but I would still submit, it's not necessarily doing great, right? So that whole pickup that we've been hoping for in terms of private capex, it is still something that we are hoping for. It's not yet visible in the numbers at this point of time. It's only the government capex which has sort of held up. But even there, if you take government capex plus PSU capex, the overall impulse is actually more or less flatline now for a few years. And remember, Niraj, that you're going into continued fiscal compression, right? 5.1% fiscal deficit this year, then again 4.5. So I think the backdrop has certain challenges. We cannot say it's zero challenges. Some of those challenges could be related to global growth. Some of those challenges could be related to NIM compression, which the banks might experience this year. So there are some challenges in getting to 14%, but at least the bar is not set at 25% earnings growth. So the market's looking at a number which is perhaps slightly more in the realm of what is possible.
If there was a disappointment thereof indicated by Q1 earnings, where we might see maybe margin compression because of higher commodity costs or otherwise, could there be a possibility of a swifter than anticipated corrective move in the markets, because it also coincides very, very interestingly with the election calendar? Yeah.
Look, the valuations are rich. They are slightly rich in the case of the large caps, slightly above the comfort zone, but they're not blinking red.
Yeah.
They're far more uncomfortable in the mid cap and the small cap plays. And I would submit that, at these valuations, you really need earnings growth to not only deliver, but even to deliver some upside surprise.
Yeah.
I think that's a very high bar. So I would be skeptical about earnings ability to sort of really outperform significantly on the upside. Whether the markets correct by going nowhere for a period of time, whether they correct in valuation terms by, coming down sharply, that's very hard to predict. But I think people should be aware that valuations are posing a challenge to, the returns that you can get from economies. A lot of the potential of businesses is reflected in their multiples. And if it's reflected in their multiples, it means those earnings expectations are baked in. Now you really need something far better than that to give the stock price a lift.
Would there be a cushion of domestic flows at the dips? You yourself would be getting in money every month, every quarter.
Sure,
How strong is that flow to cushion the impact of the fall?
Very good question. Two ways of looking at this, and I think everybody should be aware of it. Obviously, the SIP flow, I think, gives us a lot of visibility. But when I peel back the SIP flow and I look at the rate of cancellation of SIPs, it does seem that there is some momentum seeking behavior visible even in the SIP flow, right? Because how many SIPs are actually persisting beyond 1 year, 2 years, 3 years? The numbers, I must say, are slightly disappointing. They're still good in an absolute sense compared to where we used to be 5 years ago, but if you just look at the headline number, that's a bit misleading, because there is a high number of SIPs which are getting cancelled, and then people are opening new SIPs again. My interpretation of that is there is some bit of return seeking, momentum chasing behavior which is there, but I still think the SIP will give stability, it will give support. The mutual fund Sahi Hai program which AMFI has been running goes back now almost 7 years, 2017, and I do think in my travels across the country, when I meet people, there are a large number of investors who've started to think about this long term. They're thinking 10 years, 20 years, but on top of that, there are some people playing momentum, and that's what we should be a little bit worried about.
Got it. Does the commentary from a company like Accenture worry you for what could be happening to what is arguably a very large sector in India, which is in IT services? Because that's, aside of banks, that's the other key conundrum for markets.
I think certainly there are challenges on the IT side. It's been visible for a while. Even the Indian companies have been articulating challenges over there. They've been winning big deals, but the challenge is in many of these cases you're losing something which was a legacy business, and now you're announcing a new deal. So the net benefit to the company, you have to offset the legacy loss with the new deal wins. You can't just keep adding the new deals without recognizing the fact that there is some legacy business which is going away. So I think that challenge will continue. Everything that we hear from the US suggests that tech spending is going through a difficult period. This is visible in technology, it's visible in the classic IT services, it's visible in support, and it's also visible in the consulting side, right? So the top end of the market, discretionary consulting, badly affected, services less so. The only point that I would make, Niraj, is that from a domestic economy perspective, one of the strengths that we've seen in the economy in recent times is not the growth of just the classic IT services, but the rise of global capability centers in India, where you have multinationals setting up their own sort of research units here, doing research, doing coding, and doing a lot of stuff which is core to their own enterprise. And that, I think, will continue to sort of grow. So overall, IT services and related exports from India should continue to do well, but the classic listed IT services companies, particularly the ones with a lot of legacy business, I think they are going to struggle a little bit more to handle this transition.
Last question. Amidst this rather, forgive me for using that word, cautious note, where is it that you are the most optimistic on?
Yeah, I should just add one more point on that IT bit, which is, look, these are India's most globally competitive businesses. So our view on IT is really that, buy the dips. If they get cheaper, we are happy to buy them, because we think they will eventually come out on the right side of this. So not that despondent in that sense.
Sure.
No, I think equities are just rich. So really what we are trying to tell people is go back to the drawing board, look at your asset allocation framework. It's very likely that with the strong rally in stock prices, your equity allocation may have moved higher than where you were in your asset allocation framework. Go back to what your framework is telling you to do. So even in some of the schemes that we run, which sort of run our own internal asset allocation models, we used to be at 65-70% asset allocation. Those have progressively kept getting cut, and they are down to about 50% equity allocation, right? And 50% in a strategy which can be as low as 30, as high as 90. Right? So that should give you a sense of the fact that the equity allocation is somewhere more neutral at this point, and these valuation metrics largely look at large cap, not mid and small cap. If I were to use that, the numbers might look worse, but I don't have 20 years of history, so we run it only on the large cap space. But that's my simple message to investors. That's been the message from January. Rebalance, 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 keeping in mind your long-term goals, rather than falling for the narrative of this is India's decade. It might be, but that's no reason for you to move away from your asset allocation framework.
Superb message to wrap this up. Vetri, thanks so much for taking the time out and being with us on Talking Point today.
Thank you. Delighted to be here, Niraj.
The pleasure was entirely ours, I must tell you. And viewers, thanks for tuning into this edition of the Talking Point.